so that it beats in their hearts. Neon lights, background snippets, catchy sights, navigating through the crypto maze. By the dip, don't let fear take your ways. Market's volatile, but it's your game. Stay in the loop, don't let the chaos tame. Don't trip by the dip, hold on, don't slip. Keep your eyes on the prize, let the numbers rise. Don't trip by the dip, stay strong, don't quit. Ride the wave, feel the thrill. In the crypto world we will. Tokens rise and fall, it's a roller coaster ride. Stay informed, keep your head on the right side. Bull or bear, it's all about the strategy. Trust the process, let the gains multiply. Don't trip by the dip, hold on, don't slip. Keep your eyes on the prize, let the numbers rise. Don't trip by the dip, stay strong, don't quit. Ride the wave, feel the thrill. In the crypto world we will. Don't trip by the dip, together we'll win, we'll tip. The scales in our favor will thrive. In the crypto world we'll survive. Don't trip, dip, together we'll win, we'll tip. The scales in our favor will thrive. In the crypto world we'll survive.
Met her at a blockchain party, she wore a Bitcoin necklace. Said she mind her own ether, because she passed my stress test. Kept talking decentralization, my heart began to sing. But then saw her exodus, now that's a crypto fling. You don't really love me, you just love my crypto. You don't really see me, you just see my crypto. You sick Crypto slut, need some road dog, you know. Then came another gal, met me on a trading app. Told her my wallet was fat, her greed made me snap. Wanted my private keys to unlock all the gains, but she was just another fashion link in my chain. You don't really love me, you just love my crypto. You don't really see me, you just see my crypto. You sick Crypto slut, slut, need some road dog, you know. Maybe I'll find one in a cyber cafe with no gain in her eyes, just love in her array. No fake QR codes or wallets to hack. A love that's decentralized, no strings in the back. Then rolled in a Satoshi, claimed she knew all the tricks, but her blockchain was shady, full of pump and dump pits. She said, hold out together, I'll take you to the moon. But I ain't buying her Ponzi loves, my bubble to croon. Yeah. You don't really love me, you just love my crypto. You don't really see me, you just see my crypto. You sick Crypto slut. Look. Need some road dog in her. Maybe I'll find one in a cyber cafe with no pain in her eyes, just love in her array. No fake QR codes or wallets to hack. A love that's decentralized, no strings in the back. Then rolled in as Satoshi, claimed she knew all the tricks, but her blockchain was shady, full of pump and dump pics. She said, hold it all together, I'll take you to the moon, but I ain't buying her. Ponzi loves my bubble to croon. Yeah.
Check 1 2 1 2.
We chase digital highs. We race the blockchain tides. And yet I buy. And yet I buy. In this alone I cry. No cold wallet, no secure home.
It's 8:02. I think we'll go ahead and get started here.
My coins get hacked.
For those of you out there that have been hitting that like button, I just want to say thank you.
Hi, Elvis. Elvis supposed to be on vacation right now. All right, welcome everybody to the chart school. This is number 5 in counting here. Tonight I'm going to focus on the moving average strategy. Kind of recap just shortly, go over what, recap, summarize what we went through so far. And then I think it's a good time that we can start introducing maybe a few indicators in here. Right now, I don't know. I'm just going to bring this up. It's not really appropriate, or not really tied to the chart school, but I'm excited, so I got to talk about it. Got 2 songs released, 2 singles released over on Spotify. They went live today, so the 2 songs you heard in the introduction, the first 2 songs, those are available over there. That just, I don't know, trying something a little different, something new, something I've always wanted to try. Anyway, let's get over to the charts. All right, so in the past, we went over horizontal. We started out looking at horizontal support and resistance. I need a nice clean chart. Can we get a clean chart? Let me see if I can find one. Bitcoin, we'll probably stick with Bitcoin here. And how about this Bybit futures contract? Yeah, I haven't marked you up. So briefly, we started out going over horizontal support and resistance. Man, there's not much of a chart there, is there? Here's one. And we also discussed zooming out on the bigger time frames, like you probably want to look at. It's a good idea to do this periodically. Start on the monthly and get your levels, right? Some of those important levels. But we might want to look at some things that might be of interest. And working on the ones that are closer to the price action, there's no need to go through here and just put all the little areas there. We just need something that's kind of local to us. Might want to mark that monthly candle wick there. Now, I like to use wicks or dotted lines for the wicks and solid lines for the candle bodies. That might be one idea. Come down smaller time frame like the weekly, and we can start seeing maybe where they show some strength here or something. We might find some other areas to look at. Again, the monthly kind of does a good job. Come down to the daily. See if we need to tweak any areas. Like right here's a good one. Right here, mark it a different color because I'm using a different time frame or something. And this can help you identify the ranges that we're in, especially the ranges if we're starting to get into a range. Okay, so we went over horizontals, and then we started getting into the trend lines and some of those ideas. And along with trend lines, to give you a little extra, which I talk a lot about using the angles when you find them. because that can be very insightful too, which opens us up to the idea of patterns, which is what we discussed on the last one. We started getting into patterns, mostly on the channels and triangle ideas. Although, we did go over this guy right here, and you can screenshot that, copy it if you like. It's available in the Telegram group too. I think it's pinned up there. I've got a lot of little cheat sheets like that, bullish divergence and Bitcoin dominance and all that stuff, and that's all available over there. Volume cheat sheets. But that starts getting us into pattern trading, which we will continue with. But from what we went over last time, we should have enough to start being able to kind of work out with, because if you got your triangles, well, you can find those little guys with your trend lines. You can find them. Trend lines, we went over trend lines as being one of the most important things to help you with the trend, knowing when you need to think about exiting or making sure you're at least getting paid whenever you're breaking up a trend line. You need to be thinking, I need to do something. Now in a bullish market, you do see price tend to go up a little bit before it drops. That's a bullish sign. That's good. It's not what happens all the time though. In a neutral market, we kind of go sideways or whatever, but bearish markets, or if we're on a bearish trend, you'll see them drop a lot quicker and come down. So we follow trend lines and watch them as they mature, and they will usually drop a couple of times, and we hope we get a mature trend line. Eventually they will. Eventually we're looking for about a 45-degree angle as being a mature trend line, and you'll have these bigger angles, or smaller, I guess they're smaller angles. Well, you no, 40, but yeah. So these would be like your 30 degree or less angles there. I'm having to do math in my head here. But the trend lines are very helpful to help you navigate. And here's another idea. We talked about how to use the order of operations with trend lines, on how we get our base trend lines, then we get trend lines established off of them, going from the last touches and going to candle bodies, and we'll help you identify those guys. And we lost that last little one right there, so this one's likely to come back and touch the bottom. It's one idea to look at it. One idea. It doesn't have to, but it could. And then we also got our horizontal areas over here, showing areas of support and resistance for Bitcoin. So that's the ideas that we're looking for as far as trend lines go. Now, getting into the moving averages and indicators, they can be helpful for times when we get a breakout or look for a breakout. So if we got a trend line and we're trying to look for a breakout, maybe I should find one that's already happened somewhere, like maybe this one. You're following a trend line and you're like, well, what's this one going to do? Local pattern would be a local falling broadening pattern, 72% chance they break to the upside. When would you get in? And this is where the moving averages are coming in. It's going to, you can use them as a signal or a trigger for when to enter a trade. You might want to go with other triggers or something, but for a trade setup, I mean, you need a setup, you need an idea. Like for instance, on this one, we would take a measure move. We also went over the basics of some measure moves and showed you the patternsite.com. Where you guys can learn to your heart's desire about patterns, and I recommend that you spend a lot of time over there. Other things other than just patterns, but that's kind of the textbook, I guess, if you will, for our thing. If we were to take a Bukowski measure move, we would take that. If we were going to take a standard measure move, we would just go from top of the thing down to a bottom. Its last touch is pretty good. So we got two measure move ideas that we could play if we were trying to do that and do a trade setup, right? They may or may not be hit. But we would be working through this. We'll go over this probably in another thing, but I'm just laying these things out as I use them. Oh snap, what happened? No! That wasn't supposed to happen? What happened? I don't even know what that was about. Okay, we're still here. All right, so we got our little long tool here, and if we were trying to play this traditionally as a breakout, set up a trade idea, and let's say we didn't take the Bukowski measure move. That's more of an advanced measure move, right? We would just take the standard measure move that you do the width of the channel. Put that there. We got a trade set up. Okay. Well, when do you enter? You need a trigger. Okay. So you have a trade set up. You have an idea with the pattern, but when do you enter? Now you got several different ideas here, and we'll get to moving averages. I promise. Until then, let me go ahead and shut them off and turn the music down a little bit. All right. So if we were playing this, we'd be looking at this trend lines, beauty of trend lines, and we're waiting for a breakout. Ideally, you'll wait for the next candle. You wouldn't buy the one that's going out. You'd wait for a confirmation. That's the smart thing to do. We don't always do what's smart, though. Sometimes our little degen gets to us. Sometimes we're a little bit more risky than not. But the idea is, say, we're on the daily. We're looking at this on the daily. That's where we are doing our setup, okay? So if we're doing this on the daily, we want to abide by those rules on the daily and wait for an actual daily candle body to open. That would be the correct, less risk adverse way to do that. Is that what I'm saying? Risk adverse. But that's called the breakout trading, and that's not a favor. That's usually what everybody learns, is how to trade the breakouts, right? And a lot of times you'll see them take price up, and sometimes they come back into the pattern and it's a failed breakout. They're not always beautiful like this. Sometimes they're lackluster. You never, like a box of chocolates, you never know what you're going to get. But the moving averages can help you with that, and we'll get to that. The first thing I'm trying to get to is what a trigger is. Now, I use a moving average for a trigger to tell me when to get in a trade, or to confirm if it was a good idea to get in on that trade. However, I got to say a word here about breakout trading. After you get stopped out for a while and everything, I think eventually your mind will start saying, well, I don't like this. I'm always getting stopped out, and then price takes off without me. Surely there's got to be another way, and there are other ways. That's what led me to start following these patterns and trend lines and trying to catch them at bottoms, and when they show signs that they're leveling out and trying to break to the upside. Now, you might get caught in on something like that, buying a little too early for another drop, and that's when you have to use, maybe a different strategy of layering in on some of these ideas. That could be one approach. Or you just get stopped out on that one and you charge again at the bottom. A lot of times doing swing trades, layering in, doing the little pyramid, that's a good way to get into this. So it means that you start out small and gradually add more and more. Or if you start out small here, you wait for another thing and see that you catch your signal down here or something, you can enter in at the bottom. Next time we start touching the bottom of trend lines. Touch a little bit when we touch the bottom of the trend line, or establish a trend line, whatever, at the bottom. A little bit more at the bottom. Those are some ideas on how to get in. Some people go all in. Some people just layer in. After a while in the game, I think you start layering in more. So, but let's say this one turned out pretty well, right? We got a nice little setup there. But what would be a trick? What would be a good confirmation that, hey man, maybe yeah, we got a breakout, maybe it'll stick. Or one little sign that, hey man, maybe we could front run this a little bit. Because at some point, your DGen's going to want to front run. I don't want to trade the breakout. 9 moving average. When price gets above a 9 moving average and can hold it, maybe you want to wait for a candle or 2 or 3 to confirm that they're above there, because they can fake you out. Now that does happen, where we get look, we're above the 9 moving average. Well, we haven't closed above it. Now we did close here, and it gave us an indecision candle. That's called a doji candle. You see, it looks like a spinning top. That means the market is undecided at the moment, and that could be your warning signal that, hey man, don't know if I'm going to stick around here or not. Don't know if I'm going to manage it or not. You also got one over here too. In this case, it said, no, I'm not going to, and we started losing it. In this case, it says, I don't feel like it. She presents a red doji candle, right? But then she said, nope, I'm going to do it. And you could have argued with yourself, but the 9 just crossed the 200 moving average. That's bearish, ain't it? It is, but the 9 is a little bitty tiny moving average. 200 is a bigger one. And if you got some other bigger moving averages, like the 100 and the 50 above it, It's kind of like, I don't know, I think of it sometimes as balloons, those helium balloons, you know, and you got some bigger, heavier, you know, balloons up there that can kind of pull you up a little bit more, have more anti-gravity effect on you. So you're not going to drop as much as long as they're up here. Or if you do, you got a good chance of coming back up to see those guys. We're starting to get into the moving averages now. But using them as a trigger is always a good thing. And you can even, okay, so we're talking about doing a trade setup. So let's go with this idea. The most important thing here is the top trend line and seeing when we're going to break above it. Now, could we also front run it by just going to a different time frame? Remember, our setup was on the daily, but we can also, once we get our idea established, that's what we want to make our bigger ideas on bigger time frames, execute them on smaller time frames. You can go down as small as you want. Small as you want. So if I was following this idea and say we're up here and we're coming down and I'm like, that might be a nice looking area to get in. Honestly, anytime I see big dips like this, I'm buying. I just am. I'm nibbling. I'm not going hard, but I'm nibbling from when we have these big things like that, big sell-offs. And I would be using this principle probably on a smaller time frame. We'll get to that in just a minute. But here we are on the 4 hour, and it's telling us, hey man, you might be able to find something. You might have an entry idea, a little trigger idea about here if you want to try to play it. Now, it was not the greatest, strongest play. It's a little risky, but we start looking. Another idea would be when the 9 cross, or the 9, that's the green one, crosses that red one. It's a 21 moving average. When you got a smaller moving average crossing over a big one, that's usually a bullish thing. Now here we went sideways. We finally went up, but then we got rejected at the top of the pattern. And when it comes to the patterns, the rule is we just bounce off the side of them until the day that we don't. So we should always be looking at bouncing off of them until they actually do something and break out. So, I mean, and we talked earlier about maybe that would have been getting in too early. She came down later and was like, oh crap, I'm in the red. It sucks. Okay. That can happen. So maybe you got stopped out. That comes with the game. Or maybe you're still in and you're like, nah, I just kept holding on. I'm going to add more and say, okay. Since we're in a pattern like this, it can work more. It has a better chance of working out for you that way, but it's still, do you want to make a habit of doing that? Because one of these days, it's not going to work out so good for you. But with the bull market, hey, you can bend some of those stricter ideas. I don't recommend making bad habits, though. So we can look for other things going on, other little patterns, W bottoms. That's good. Thought we might have had one there. Didn't really confirmed over here and lost it. Getting above these areas, but still, we come back to the 9 moving average. Anytime that we cross, that can be a trigger for if you're trying to do the strategy where you're trying to buy the bottoms, right? Now, me, like I said, anytime we get big drops, I'm not afraid to jump in on these little guys now, especially if we. I don't know. I just like it. But the more safer idea would be to wait till we get above a 9 moving average, right? That would have been a more safer entry. Come up, come down. We might lose it, but now it comes back to that trend line and it respects it more. Get above the 9, might be another entry there. And we can kind of use it to front run that way. Now we come down to a smaller time frame like the 15. Remember, we put all this together on the daily. We can use the smaller time frames to nail stuff. And so the smaller time frames, when we're getting those dumps, I'm telling you that I'm looking at, yeah. Well, that's where. Now notice on these big ass dumps where your non-moving average is. Oh, it's right there in the juicy action here. A little safer. Come down to the 5 minute or the 1 or 5 minute, you'd see the moving average even quicker. Now it's more risky to do that, but if you've already got your trend lines mapped out on the daily, you've got your bigger time frames, and you know, hey man, this is likely that this trend line will hold. If the closer we're to it, the less risk there actually is when you buy. Of course, let's just say you're so close to the bottom over here, so close to the trend line. So a 2% stop loss versus when you try to buy a breakout. Let's go back to So a smaller time frame near the trend line versus, say, buying the bigger breakout. Where are we? Did I lose it? I went up a time frame and I lost us. Come on back. There we are. Let's get over here. 4 hour. Why not the 4 hour? Why do I keep missing you? Was that you? Yeah. Really? No, that's not you. I'm getting lost in my. Here we are. We found it. Bear with me, ladies and gentlemen. All right, so and compare that idea to well, your road dog's got it getting all mixed up now. I'm losing my train of thoughts now. What I was trying to get to. We were talking about going to the smaller time frames to kind of help nail these things, and that's one thing the moving averages can help with, as far as I'm concerned. But most notably, you're looking for waiting to price breaks out of a pattern to get in, and of course, if it's in a strong move, it's going to be above that 9 moving average anyway. But that would be the general route when you're pattern trading, is to wait for a breakout, wait for a few confirmation candles, and then you jump in. So on this one, you would have jumped in about 60,000. For those of us applying a little bit of a different strategy to these patterns, we would have been getting in anywhere around 54,000 to 56,000. Now, the benefits of doing something like that, even here, even playing a bottom pattern within this bigger pattern idea, would have got you in early around 58 and then waiting for a confirmation at the breakout. The only thing is there's never any guarantee that it's going to keep going up, nor is there any guarantee over here after we break out it's going to keep going up. It just depends on your risk tolerance and how you want to play the game and how you're working it. But any one of those ideas is totally legitimate. But the safest thing to do, that I'm trying to stress, is wait for a confirmation. That tends to work out better than just, I'm just going to eyeball it and jump in. And that can work in some times, and maybe you want to do it a little bit, degen. I'm not going to tell you not to. That's how we learn, The market is the best teacher of what works and what doesn't work. But a few confirmation candles are very important, whether you're working breakout strategy or even using a moving average as a trigger or something like that. So that was getting into moving averages as triggers. Let's get into the indicator itself and what they do. What I use it for is basically to help me track the momentum. That's what it does. It helps me track the momentum, and it can also hint at support resistance areas. Now, they change. The moving averages are always changing because it's just an average of price at that particular moment in time. So it's not like if you see one hanging out, at the end of your chart, you just got them sitting there on the line. Like we can go, yep, we got support right here at the 200. For right now at this moment in time, you do. But as price comes up, it'll either be coming down or hopefully going up too. Trying to move everything up. But let's talk about the moving averages that I use here. Now, I started out with a 5 moving average strategy. And I like it a lot, and that's what I'm going to be teaching you tonight. And then I added 3 more onto it, which have just, it changed. It just opened up that strategy even more. You guys have probably seen a few indicators that, do I have it on here? Like this one. This is Market Cipher A, and there's also like moving average ribbons. I don't know, and there's a lot of other indicators that also have that. But when you see it put together like this, they're taking a bunch of all these EMAs, in this case, exponential moving averages. We'll get to that in just a second. But they align them up, and what you have is this ribbon. It makes a ribbon, and that's what you need to understand when it comes to these moving averages, and especially my strategy. because I'm looking at them as a ribbon. I'm just not using all of them. I'm using ones that matter the most and have the most effect on price that I've found that work for me. But you see how the ribbon, it will flip. And that tells you whether you're bearish or bullish when you get the flips in the ribbon. And you got some of these people out here talking about moving averages, and I've just always been bewildered because you just hear when they get tight. Well, the moving average has got tight here. You know, it's usually like when you're doing the Monday morning quarterbacking and going through, and well, the moving average has got tight. I told you that this was going to happen or something, but you don't always see that going on in their live plays or anything like that. And what does that mean when they get tight? I mean, okay. They squeezed it, and then what? Well, that means it's going to the moon afterward. What happens? They get tight. That means that what we're looking for is, well, are they crossing? And that is the beauty of the moving average. The multiple moving average strategy is how they relate to each other can give you hints and tips on the momentum and where price action is likely to be going, the direction of it, the trend, and the momentum of that trend. That's the beauty of the moving averages. But this is what it looks like, and I want you to get this idea in your head that they're a ribbon. They're a ribbon, and they can flip. That means the smaller ones crossing over the big ones, and then they all flip. All the smaller ones start getting in sequential order over the bigger ones, and boom, we got a nice strong move. They start going the other way. Ooh, we got a nice bad move. And they spread out, they fan out. Notice this. And you might hear that a lot from some other people that use the moving averages. Well, it's far away from the moving average, and that gets subjective. And it's not the best indicator. I knew when to sell because it got away from the 21. Okay, but that's very subjective, and the other people following that may not, they're not thinking exactly the same way you are. So it's not the best way to explain it, I don't think. But you will see, hopefully this gives you a visualization of how they fan out. And once they do start fanning out and the spaces between themselves actually get bigger, well, then you get a reaction, usually with price. Something's got to snap back, right? It's kind of like an elastic band in a way. Once it gets too far away, I got to kind of snap back down to somewhere in the middle, normal somewhere, right? Like a guitar string, it goes up one and it comes down the other side, but it just vibrates. Right? There's a middle ground, an average area even to all of this. But I wanted to show the ribbon aspect of it so that you can visualize that's what's going on. And then they're expanding and they do contract, but it's the flippening. It's when they start crossing that you really start getting some information there. All right, let me take this off and flip my moving averages back on. We'll just go with the 5. And I want to start breaking this down. Let me say hello to everybody here. We got 5 people hanging out. Glad to have you guys here. All right, we got Road Glide and Board PC Guy. See Ryan K, and he's had a question there, and I'll be getting to that here. Glasshopper, MG Motorsports, how's it going? And Kelly L, hey, good to see you. Kelly L says I get stopped out a lot. Is it from trying to do breakout trading? How do you decide when to close a trade? Well, to answer that question, I mean, really what we're supposed to do is to plan the trade and then trade the plan. If we're going die hard trading, that's what we're supposed to do. Now we can, and sometimes I do this too. I just see a good entry before I calculate the exit. I mean, it happens to me too, but that's me breaking a rule that I know better than, because we really should plan it out. So for instance, when I was using that little tool, let me go back to this. That's actually what this is for, and more so for leverage trading. This tool is really more helpful for leverage trading because you're using multiples and things like that. But you can use it for spot too, or to get a feel. But it tells you what percentages you can put your stop loss, and then what percentage of gain. So you want to calculate what your gain is. So let's see, if I were trying to see let's see if we can put a setup here. So for me, if I were trying to play this breakout, because we do have a trend line there that's likely to break out, the moving averages are telling me that, hey, 100,000, 100 will probably be a place that might be contention. I might want to take a little bit of profit there. But you mentioned like close a trade. Well, I would trade I would have a plan. So if I were going to buy this breakout, I would be looking at this trend line here. I may do a Fibonacci target or whatever, but you would want to have a target to sell at if you're doing an actual trade, like an in and out type of trade. And then you want to make sure that your stop loss is in a reasonable area so that you have a good risk to reward ratio for, if you get stopped out. If you get stopped out and you're okay with losing $100, and that's what if you put your stop loss in place and that's what you lose is $100, well, you would at least want your target to be about $300. You want a 3-to-1 risk reward ratio, ideally. This trade doesn't really have that. It's got probably about a 2-to-1, and that's kind of meh. But I mean, some people will take that trade. Not the greatest trade, not the greatest profit unless it decides to really go up above there. Now, my moving averages are telling me that we probably won't get very much past that. We're glad to gradually get into that more on the moving averages. But you need to have an idea of when to get out. Now, another idea would be looking at the pattern that's forming here. We have the V shape and a possible round and bottom, so we might actually have to come up here to confirm an Adam and Eve type pattern. Now, that would be a 3-to-1 risk reward ratio, but what if she doesn't? What if she doesn't hit the target? And that's when you would want to, as the trade breaks out, confirms and everything, and you can get your entry, and then she starts coming up and down and everything, you move your stop loss to break even, and then maybe we get to a smaller target. You take just a percentage of your trade, maybe 25% of it or something profit, and that way if it comes back to stop you out, you won a little bit and it covers your fees, and you're not losing a trade. And then if it comes up here, your trade's over. You got your target set. So in more of a strict trading mode, that's what you're doing. Now, if you're trying to swing trade, well, you'd be doing that on a bigger scale. So I hope that kind of addressed the question. I hope I'm on topic there. Poor PC guy says, tried to range trade in the last couple of days, and holy cow, tiny but consistent wins is the way. Yeah, they will be tiny in the range thing. Most of your gains are going to be made when we have the big moves, and then most of them are going to be given up when they start ranging and we start trading in the chop. So you got to have kind of like two different strategies at that. And what most of us do, we just, we're like, oh, maybe it's going to break out at any time. So we just kind of hold tight or, ride it up and down and whatever. Especially if you're a hodler, you're like, oh my God, when's this ever going to break out? Kelly says, I've been trying to trade using the MACD when the lines cross above or below the zero line. I think the MACD is good. The only thing is the MACD is a lagging indicator, so she's a little bit behind, and she catches the moves a little late. She's very important, though. Very important. I use it because it's really good for the momentum. But as for a trigger, yeah, not the best trigger in the world. The smaller moving averages I find to be the really effective triggers. All right, so let's look at the indicators. I'm going to just use the 5 moving average. Let me get this thing off of here. Where are you? Right here. So I use certain colors because, whenever I'd put these things up before, the small one would be green and the bigger one would be red. So my 9 is green. It's closest to the price, so it's good. And if it hits the 21, it's, that's a warning sign for me that, hey man, my short range price action might be starting to do something bad. So it's red. So I use those. Blue is my 50 moving average. White I keep as 100, and yellow for the 200 because it's the golden cross. We have a golden ratio. I'll keep those yellow. And okay, so let me break this down for the impulse. Okay, these are the moving averages I use. I think they come standard with a 9. I think this is I can't remember what they put standard. Maybe it's a 13 or something. 9 is really, really really good for tracking, especially runs. A strong move to the upside. It works really good, especially on bigger time frames, on any time frame. It works really good. But I use a 9, 21, 50, 100, and 200. All right, so the yellow one is the 200, and the rule of the game here is, well, the 200 moving average is the one that tells you if you're bullish or bearish. That's just the standard. That's just the industry standard, I guess you would say. The 200 moving average is the one that determines everything. 200 EMA is what I call them. Some people say SMA, a simple moving average. And over here on Investopedia, looky here, talking about moving averages. And let's just go over this just briefly. The reason for calculating a moving average of a stock or anything else is to help smooth out the price data by creating constantly updated average price. Okay. It helps to level price data over a specified period by creating a constantly updated average price. And there's a formula for it that'll go through. But you got a simple moving average, and that's a simple calculation. Then you got an exponential moving average, has a different calculation, and it puts just a little bit more weight on the recent price action. Now, I've tried them both, and actually I used to use EMA's, exponential moving averages. When if you go back to my earlier videos, that's all I did. I was the EMA. What had happened is that I erased all my moving averages one time by accident, and I put just the regular ones back on. And I noticed that price respected the simple moving average much more than it ever did, especially for the strategy, than the EMA. I mean, with the EMA price, you get used to see it'll go below it and up, around it. It gets a general area, but with the regular moving averages, you will see price respect it and sometimes just stop dead on it. So that perked my ears up, and that's why I don't use the EMAs. I stick with the SMAs. Just back tested it, and it worked. Try it yourself. Go with what works for you, but I'm just telling you what works for me. Okay, so a 200-day moving average will have a much greater degree of lag than a 20-day moving average. Okay, the longer the period of a moving average, the greater the lag, so we keep that in mind. This goes over the formulas and all of that, but they basically help you determine trend direction, momentum, and ideas of support and resistance. And it even says that here. Some people don't like to hear that. It's not solid support resistance. It moves. So and it says, while it's impossible to predict the future movement of a specific stock, using technical analysis and research can help make better predictions. A rising moving average indicates that the security is in an uptrend, while a declining moving average reveals that it's in a downtrend. Similarly, an upward momentum is confirmed when a bullish crossover, those crossovers when they cross, which occurs when a short-term moving average crosses above a longer-term moving average. And also, conversely, they can go bearish that way. All right, so we don't need to spend any more on the white page, I don't think, but you can study moving averages. Investopedia is a great place to boost your education on a lot of these things you're not familiar with. It's in the technical analysis section. And then you've also got the patternsite.com. You hear me refer to that a lot. Thomas Bukowski. And then, of course, we got a lot of free resources and books and things available on the Telegram group. All right, so the main thing, if you're above, I'll say is your moving average. If price is above it, you're bullish. If you're below it, you're bearish. And then we're talking about that's on any time frame, but especially on the bigger ones like the daily and the weekly. Those are the ones where it counts the most. So when we're below the 200 here, we're in a bearish predicament right here on the 4-hour chart. And the chances are that we can come up to it. Now look, we came up to it before, and price can go above it. It can, but it gave it back down. And they can make some good price targets. And I think your Fibonacci's do a little bit better, and Fibonacci in conjunction with that will do a little bit better. but they can make some decent price targets. And in fact, another popular YouTuber uses the 200 moving average for his main strategy, like on the 1 minute, and walks up the time frames with them, basically. Just walking up the time frames. All right, so we kind of center everything around the 200 moving average, on what side we are on it. Are we on the bullish side or bearish side? Well, the 100 just crossed, and now they've all flipped. We talked about that ribbon flipping. Well, it just happened here on this 4 hour. All the ribbons, they've officially flipped. Sounds bearish as all get out, right? It can. That's where you go to the bigger time frames to help you figure things out. So I'm going to come to the bigger time frame. And you hear me do this a lot on my show. We're talking about the 9 moving average. We're trying to get below it. If we're below it, we're in possibility of coming down. There is a dance of these 5 moving averages, and that's what I probably need to address right now when it comes to these. And maybe I can draw it over here. This is going to suck. Let's see if we can get this kind of accurate here. So when they are stacked in their order, they'll look like this, right? But when they start crossing, such as this little guy crosses bearishly over this one, well, that sucked. We'll figure this out. So we cross bearish, and that means that the price is probably declining. The price is probably already under these moving averages when that's happening too. So a bearish cross, and that shows weakness, right? And so the rule of the game is price. It'll be either. Let me get something for price. Let's go with what color am I not using? If price will be above one of these and may lose one and come down, it will respect to the 21, to the red one, right? The 21. And then bounce back and retest the green one. And this is before or even after they cross it. They usually follow this sequence. From there, if it can't get back past the 9 moving average, well, it comes back to the 21, most likely, does not catch support. It will come down to the 50. From there, we normally it can bounce. If it does not bounce, we go down to the next one. But if it does bounce, we come back and we talk to the 21 again. And see, and if we can't get past it, then we come back to the 50. My lines are just not, this thing is hard to draw on. Then we come to the 100. This is the same thing. You'll go back and talk to the 50 and then come back to the 200. And it's got to dance like that. Now, I can't say that works perfectly every time, but I would say most of the time I'm looking at it, I'm seeing exactly just that. I can't think of any instance at all that I can call out where I haven't seen that respected. I pay more attention to it. I look for it when it's not, but I can't think of anything when it doesn't do that. It respects the move. There's a dance. They dance. That's why we got dancers on the stream, because the dancing moving averages. There's the secret. And it sounds kind of crazy, but it does. It does. It does. So and it doesn't mean that they're always going to bounce when they hit those moving average, okay? Because sometimes they can fall through one, but you're always looking for that next little guy. And we can probably see it better on a smaller time frame. Let's see if we can find an example of where this will happen. Let's see. Here's where we're starting to get some crosses out of the... We got above the... Price got above the 9. See, we lost everything. The last thing that we touched, the 100, right? And then we come down, talking to the 9, nothing lower than the 9, get below the 9, regain the 9. Well, then what we got to do after that? Last one we talked to is the 100. We go backwards. Now we got to go to the 200, and we did. Went above it. Now what we do? What's the 200? The 100. Come back to the 100. Well, what after that? Well, we kept going up. The 50 would normally be the next one that we tap, but the 50 was below us, and we didn't do it. But we did start respecting the 21 and riding it up. Okay, up here we're above the 9. We lost the 9, came down to the 21, bounced, came back to the 9, dropped all the way down, went way past them, but we came back above the 50 because the 50's next in line. From here, yeah, I wish I could go to a smaller time frame. It would actually show the candles playing out better, but we'd have different moving averages up there. Okay, so we closed the candle above the 50, came back up to test the 21, the red one. They got rejected there, so the 100 is our next move. Went down below it, closed the candle at the 100, closed candle above the 100. From the 100, we would go to the 50. Rejected at the 50, the 100, and then we start looking for the 200, which is nowhere near here. The 200 is back here. So we just blew out through everything, lost all those, until we finally come down to an area where we find support, and then we start looking at our moving averages again. We start looking at the 9 to start building back up. So get above the 9, 21, retest the 9, 21. It plays around a little bit, and then we start moving toward the 50. As far as we can go, coming back, testing the 50, bounce off. The 100 would be next in line, the 200, and there's just a little dance. It's not the most beautiful example there. We can probably find some other ones, but just keep that idea in mind as you play with them 5 moving average strategy. That's what they usually do. The price usually respects them in a sequential order too. And it's just something I've just found kind of fascinating with the moving averages there. And so when the price relationship to the moving average is important to help you determine if we're on a nice trend. And I always say if you're above the 9 moving average, you're doing fine. When you're in a strong trend to the upside, when you can actually draw a nice strong trend line, you're going to be above that 9 moving average. In a strong trend, when you lose a 9, you normally come back and test the 21. When you test the 21, you can bounce back above the 9 and then ride it on. In a deeper correction, you might lose it and come back to the 50. Now you see it respecting these bigger moving averages just because they happen to be there, and so you will get some reactions about that. Normally you're going to be above or below those guys, but if they're in the mix too, they'll have a reaction. All the moving averages, it's when price comes back full circles to itself is basically what it means. That means that where the moving averages is right now, where the 100 is right now, over the past 100 candles, that is the average price. So when price gets back to its average place, it will normally have some kind of reaction. It's either going to do something or it's going to continue on its way. It's either going to have, stop and they have to think, or maybe reverse at that point, or, just go on to its merry way to the next one or the next little area. But when it comes back to the average price that it was before, it meets itself. It's like, hey, deja vu, I've been here before. That's just kind of how it works mathematically. In a non-numerical way of explanation. And hopefully this is making sense, but okay, so price above the moving average is important, and then we talked about the spacing of them can be a guide, but it's when they cross that's very telling to me, and I'm always looking for the crosses. I'm always looking for the 9 when it crosses the 21, right? Especially if we're trying to get bullish and go in an upward trend, because when it can get past that 21, then we're more likely to get and stay above the 9. We're rocking. That's what we want. We're rocking. And they start crossing the 9, starts crossing the 50. Yeah, we're gaining some more momentum. Yeah. So every time that little 9 crosses a bigger moving average, we're getting some more momentum. We're getting some more punch. And then the 21 starts getting into the game. Well, I'm going to start crossing some moving averages too. And then overall, that can give us some momentum. Now, you may not see it reflect on the price at the moment. A lot of times when you see the bigger moving average start to cross, the larger ones starting to cross over even larger ones, sometimes there's a pullback. Sometimes you might see it's bullish overall. It's bullish for the bigger momentum for the upcoming move, because they're based on different time scales, right? Or based on different time frames, I guess. 21 candles versus 9, 50 candles versus 9, see? And so they lag a little bit. So when they cross, it's going to be a little bit before we actually get the move. Like it was 1, 2, 3, 4, 5, 6, about 6 to 7 candles afterward before we actually started seeing the real impact of that. And by then, the non crossed the 200. It didn't just, that didn't mean price boomed up yet, but that was good setup for what's going to happen here. So all these things keep adding up and the momentum. And then pretty soon we start closing up that gap, and this is literally getting tight. They're crossing, this is what they're doing. They're crossing. The ribbon is trying to flip. And here on the 15-minute time frame, is this current? This is Bitcoin right now. We're doing TA on Bitcoin right now, 15-minute time frame. Even though she's lost this trend line, which is not the best thing, maybe it will level out. Remember, we're trying to look for somewhere around 45-degree angle on average. She's not solidified yet, and she could drop, and we can look moving averages or in measured moves to get an idea where she could come down to. When try to put all the stuff together we've been going over. Measure move from the highest peak there to the bottom of the trend line, put it at the breakout, and it suggests maybe we might come down and tap this. Maybe. Happens a lot of times. We're in the 15-minute time frame. We got time to do that. Notice this though. There's no cross of the 9 over the 21 yet. Now that can still happen if we get the momentum. You know, we lost the 21. 50's down here. The only thing that can keep us from hitting the 50 would be these two guys, and they're doubling up, so they could add like a double level of support. You see how that's working? So that might actually bounce here, and we don't have to come down to the 50. See how you see? Can this make sense? See how it's working? But if now the 9 crosses the 21, well, that's a bearish cross, and that just means there's some down momentum going on right now, and we may see that. We may still see that. Especially after breaking a trend line. That's kind of the ideas I'm looking at. It's a warning sign. Breaking the trend line itself is a warning sign, but then that's just a minor trend line. That's not the main trend line. Definitely not when you zoom out, but just this overall trend line gives us a clue. Also pointing to this area. Little line here, and even the 50 moving average kind of line underneath it. So I'd be curious to see, you know, are we gonna wick down here? Or are we just gonna bounce off this area? That I don't know, but it's telling me we got a good probability we can bounce right here. If I want to find out more, well, I just don't know. I'll probably go down to the smaller time frame, like the 3-minute. What are you saying? Well, we got she's gonna have to do something really bullish right now because 9's crossing that 100. My only other clue would be that 21 and that 50 on the smaller time frame. They look like they could. It looks like what we might do is come up and talk to the 21 and then get rejected and then come on back down. That's what it looks like. Doesn't mean it has to happen. Put some of the other ideas that we had. I don't go from that wick to that candle body because it's a steeper angle. But that's kind of what our channel is doing right here, is doing that kind of idea, right? Normally, I mean, for the stronger move, I'm going to be telling you to go with the bodies. That gives us in the channel. So you start putting these ideas together, layer them over on top of each other, and then the market starts clearing up. It does for me. When I start layering these ideas on top of each other, it starts painting a bigger picture. This starts talking to me. It starts telling me some things like, you know, if it's more in the mood to go down or if it's more in the mood to go up. And you can start seeing, you know, the areas that could be your resistance and how it could play out. And you get a lot of these little signs showing that you've got resistance in the area. You got confluence, and then it's those ideas that help me to get the better areas that price is likely to hit. And I don't know. Hey, is this making sense to everybody? Let me go back to the chat and see what you guys are saying. MG Motors says, when's this ever going to break out? I'm looking at you, Ethereum. I feel you. Are candle confirmations better combined with support resistance or the crossover of moving averages? Let me repeat that. Are candle confirmations better combined with support resistance or the crossover moving averages? I don't know if you should look at, well, I don't know if you can top over a candle confirmation, because that candle is going to be reflective of the price action. So I would probably put more importance on the candle confirmation. But I would use them conjunctively. I use them together. I'll be looking for both of those things. I'll be looking for that candle confirmation with the support resistance, and then also noticing what the moving averages are doing. You use them all. Use every tool in your toolbox whenever it applies. I hope I addressed that. Like, I'm trying to see if we've got an example here. This is a horizontal area of resistance that we're at, support and resistance, right? So I guess on that, I see no bullish cross of moving averages that would get us above that, other than us coming to test this 200 moving, or that 21 moving average. And we could wick up there. This is support, but we don't close a candle above it. Then, you know, the moving averages, I mean, they're being bearish anyway. They're telling me it's not as likely to happen, that we're likely to come down. But yeah, I think to answer your question, I would say the candle confirmations, you always want the candle. It's a safer, less risky way to do this. Meaning that you'll probably be more successful by just waiting that extra, even though you may not save the few extra dollars or few extra pennies on your entry. You're more likely to actually avoid getting caught up in something that didn't work out, because they can fake us out, and they will start faking us out in this market. Don't think that they won't. They'll get you at a perfect set out, perfect breakout, maybe break you out a little bit, and then the market makers are planning to do a flush, and they'll take things down, stop everybody out, and then they will shoot that price up. And when you start seeing them do that, they're out for blood, and they're getting ready to rock the world out of that market. And right before we start getting really bullish, really bullish, you'll start seeing a lot of stop outs, a lot of dirty stop outs. You're like, man, it's just dirty. It's like, I can't believe they did that. I'm talking like a setup like this, they would break you out, and then they will drop it down here, clean everybody. They will come back up, maybe do it again. I mean, they're like a heartbeat pattern or something like that, and then they go. And you'll see that, you'll start seeing them do that on smaller time frames, and lots of you can start seeing that stuff happen a lot. Know that in the next day or two, yeah, that price is getting ready to go somewhere. What happened to my stuff? There it is. So that's one good little thing to keep an eye on when it comes to price action. When they start getting dirty, they up to something. They're getting ready to do something. Kelly L says Ethereum recently became my biggest bag. Hope it goes up too. I think it will. I do believe it will. I think you have to be patient with it. I think they're trying to flush everybody out and make you think that nothing's going to happen with it. Ethereum's got a lot of older money and a lot of big money behind it. It's been there before a long time. I know they got a lot of problems to solve and things like that, and things that could go better. But they got the momentum behind it. It's just that they're not letting they're not releasing the ball to let it start rolling just yet. They're holding it back right now. But the big money's had their eye on Ethereum for quite a while. The people that don't like to change horses midstream, those kind of people, that big money, that's coming in. Kelly L says, what does it mean when price is far above the moving average? Oh, I think when you hear people say that, they'll say it's too far above the moving average, and that's just so subjective, that doesn't tell you anything. That, my friend, is why I use these guys. Let me get into this. Now, we were talking about my 5 moving average strategy. And let me get this. And what you would normally do, well, let me get back and try to answer your question here. Okay, so here, we're in the 3-minute time frame. This is the 200 moving average. Now, how do you know if we're too far above it or not? What the hell does that mean? That's so subjective, and from where? I mean, there's nothing here. It's far above it from anywhere. It doesn't mean that it's going to go down or anything, because the 200 moving average can follow right along with it, right? So that's just a cringe moment for me when I hear people, the teachers say that, because that doesn't tell me anything. Let me get the question back up again. So what does it mean? Well, if anytime you're above the 200 moving average, you're bullish. So that's not going to change. But we can start coming back closer to that 200 moving average. One of the things that I've found that helps me, not in every time, but especially if it's like really bullish, they may not even come into play. But if we're recovering from bearish activity, I find that the bigger moving averages help. Before I get onto that, what people normally would do was just change a time frame. Okay, so here on the 3 minute, we're above that 200 moving average, right? Let's go to the 6 minute. Where are we at here? We're above it. 15 minute, where are we at? Oh, we're closer to it there, right? 24 minute, where are we at? Oh, we're below it. Oh, crap. I've got I've got a 36 minute, I've got a 1 hour. Let's go to 1 hour. That's kind of standard. You go to the 1 hour and we're below it. So it depends on what time frame that you're on, but you can always look to your bigger time frames for your more solid answers. So like there on the 3 minute, I mean, we're far above it. But on the daily, we're above it too on the daily. That's good. We're far above it on the daily here. What does that mean? That's where the other moving averages will help you. When you're far above it, you've usually got the other ones trailing closer to your price. And here, as an example, where we're going sideways, and all price will go sideways, and then all the moving averages will come up and just start meeting it. But the other thing, other than trying to move from some time frame to time frame to see the relationship, like here on the 12 hour, we're right on it. This is one to watch right here. For any time frame that you meet where price is touching the 2 hour, hang around that time frame for a while, because it needs to react. And whatever time frame that you're touching that 200 moving average, you need to be watching that one close, because I'll tell you if we're going to stay bullish or bearish, at least on that time frame, and that will influence the others. But another thing, so that's like going to the time frames. But now a way that you can do that, or get a good sense of that without having to chase all the time frames and switch them up like that, is just that's why I added the other moving averages. And so the bigger moving averages that I've added to make my ribbon bigger. Remember that ribbon? That's all it is. Just look at it as a ribbon. And well, it tells me that we're still bearish. We're still I'm on a 36 minute time. This one's telling me we're still bearish on this time frame, because I got an 800, a 666, and the 360. That's the moving averages that I added. Let me put them up here. 360, the 666, and the 800. And I just started playing around one day and started back testing these bigger moving averages. I'd seen some people use the 800. I was like, okay. And I would see that, it'd start be respected on the charts. And I'm like, okay, I might want to take a look at that. And then I found the 666 as a joke. I thought, we're just going to plug that in. I thought it was just, just to say, no, that one, price respects that one. And then they stay close together, but I watch them for when they cross. And like over here, I mean, it crossed here bullishly. Lucy crossed over the 800. These are my two biggest moving averages, and the two biggest ones crossed, and that was bullish as bullish AF, because we got all this move out of that. And then here, it's a little lagging. I mean, she'd already started moving, and you already lost the Lucy line, right? So when I'm using the bigger ones, right, when they flipped and everything, and we got the big run up, well, if we start coming back to touch those moving averages and losing them, that's not a good sign. So that would be one sign to tell you, hey man, maybe we need to think about or look at things closely. But that was a drop. And then she came down and talked to Lucy. That's usually not good. Most of your drops usually coming back down to that 666 moving average or 800 moving average a lot of times. And here we got above them, but the cross was here, and it was already after all the downtrend. But some of the things that could save you from the downtrend is when price comes back to those moving averages. That's kind of be sitting there hoping, I hope we bounce, maybe it will. and it doesn't. I think that was the move that a lot of people, I mean, it would have been hard to predict anyway right here, but there were some signs. I mean, the 360 crossing that's there, you're seeing that was crossed, and that was when we were still here. And then what happened after with the big drop? So this is the rollover of the moving average, the bigger ones that count. So when you see them interact with each other, there's usually you want to listen. And then here we got the negative move from it going over. And we've just been on that little downward run, staying under this 360 all the time. So they flip. So now they need to slowly accumulate, and then the other ones need to start catching up with it, right? And I think that's what's trying to happen right now. The normal 5 moving average that we have, or they got to work their way up to cross the 360, and then come up here to talk to this one and that one, and eventually they will start rounding out and then flip, kind of like they did over here. They flipped. Where else have they flipped? Way down here. Our last little accumulation zone down through here. This is probably a good case study for all this. See that they flipped, and then they flipped negative, and they flipped bullish, and then quickly turned around and flipped. And in smaller time frames, you can see that happen, but not so much on the bigger ones. It takes a lot more to move them on the bigger ones, and that's why you get more accurate information on the bigger ones, on the bigger time frames I'm talking about. But if you just look at this as a ribbon that's flipping and flipping, I think that will help understand. And then you start seeing, well, it's flipping because moving averages are crossing. And make sure I stress this. When it comes to, you can tell the momentum by the moving average by the degree of intensity that it crosses. If they're crossing at a strong angle, I mean, that's these 9s just skyrocketing up, 21 skyrocketing up. Those are strong moves when they start going that way, and that's a sign of the whole move is going to be strong. This could be really doing something when you start seeing those big angles. Or just, I know I say kamikaze diving when we're coming to the downside. Like, that's a kamikaze dive here. Those are kamikaze dives because it's steep angles. So when they do steep angles, those are powerful or strong moves, got a lot of momentum behind them. But when they're just kind of just hanging on top of each other, see, this is a shallow move here. Shallow moves aren't going to get that big of a result, especially on the smaller time frames there. So when we see the shallow moves, you don't get as much, but shallow moves going on through here for the most part. But the big steep angles is when you start getting a lot of momentum coming into the thing. So there's a lot of things that the moving average can tell you, just in how price relates to the line, the moving average lines, how far or space they are between the different moving averages. I mean, you're eyeballing that, but you see them fan out and you know that you're on a good run. Price is above a 9 moving average and the 21 moving average, you're on a good solid run. Those little things that can tell you for the momentum. And then how they cross, how the moving averages themselves cross, in what order that they get in. When they're in the right order, you're in a good strong move. When they're not, when they're going choppy, you just got them going everywhere. And then when you consolidate, you get a nice little pump up to an area, and then it goes sideways, and that's when all the moving averages start coming up. The 50 will come up there, the 100 will come up there. That's the big sign, which is the 100 come up on your time frame, and then a 200. And usually by the time the 200 gets there, you will have, that's when, especially on the smaller time frames, that's when you will have a reaction. If you're going sideways and get that consolidation, by the time the 200 starts getting up there and getting around them, that's when something's going to happen. Then you see if they flip or not. They either flip or they could bounce. And hopefully that made a little bit more sense. Ideal Sabir says, I usually stick with a 9 and 15 moving average for scalping and 50 and 200 for swings. There you go. Kelly, how long did it take you to remember all these different moving averages and what they mean? Well, it's not like it just burned itself in my brain. I think just over time, you're going to see this play out. Everything that I've explained to you, if you keep watching, you'll see it. It'll come to you. It just takes a while for it to unfold, and you go, I see it now. That's what I found with TA. because me or anybody else can sit here and explain all this stuff, but it doesn't really click until you actually see it on your own charts. And so the most important thing about learning TA and what we're doing is that you need to be out here with your charts right with me, or with whoever you're watching, Joe or Army Piper or whoever else floats your boat, has something that you find some value in, and get your charts out and do what they do. If they're pulling Fibonacci and you're like, I don't quite get it, just do what they do. That was the whole premise of the trading group that I was in, man. It's like, copy my charts until you understand. That was it. Copy my charts until you understand. That was the essence of the teaching. But if you also follow along with those ideas, then those ideas can kind of stick. And you're like, oh, it makes sense to me now. Makes sense to me now. That's what I found, hopefully. I'm staying on. So how long did it take me to remember them? I mean, it evolved over time. You probably look back on, I've probably been using these extra 3 moving averages for the last 1.5 years, 2 years maybe, adding them on. Before then, I wouldn't even think about it. So, I mean, you just learn a little bit, little by little. But I do think the 21 moving average, most people are looking at a 200, and they're looking at a 20 or 21. 21 is a fib number. 20 is the standard, though. That's what's going to be on your Bollinger Bands, is it's based off of a 20 moving average. And most people do not use the 9 or a smaller one. And you see people with the 21 moving average. I mean, there's some popular people saying, wait till price comes back to the 21 and has a reaction. And, well, okay, you can. But it doesn't always have to come back to that 21. She can bounce off that 9. And that's the advantage you got to use in some smaller time frame. There are smaller moving averages. They can give you insights to the next moving average and if price is going to hit it or not. They can give you more insight than not using the 9 moving average. And that one's a great one for identifying an upward trend. It just is. You can almost just not even draw a trend line at all. Just look at that 9 moving average, especially on the bigger time frames, or any good run. Because a nice run will respect that. But it's just like with anything else. It's just the more time that you spend around it, it'll come. I wouldn't try to force it. I would just make up some general rules. And those are the general rules of the strategy that I've tried to lay out. And this is another good example of a strong upward trend. What we want to see. And here on the daily, the price of respecting the 9 moving average, it can come back and bounce off of it. Sometimes it can lose it, regain it. So we don't really freak out until we start losing the 21. Then we can say, we might as well start doing something now. Maybe we need to start looking at something and even when it does that, say if price came down and it went below the 21, that wouldn't mean like, oh, sell now. You could, but usually the smarter traders, okay, next pump we get, or next retracement, maybe we come back up, retest something, or we go higher and do something. There's usually another bump up, and then that's where your trader's saying, okay, maybe I'll de-risk there or something. But here it is. It recovered the 9 and then lost the 9. And some people might say, oh, well, especially on a bigger time frame, I didn't take any profit at 73. She may be headed down to 50. I don't know. We're at 69. I missed 73. That's close enough. Maybe I can pay myself a little bit. That kind of idea. We come back to the 21. It bounced off of here, but then it eventually lost it. And that would have been another sign. Maybe sell some here at 66. Now, we can talk about these ideas and put them on the radar, and maybe even throw lines for alerts. That would be something. You could throw a trend line in and set an alert to let you know when price hits these areas. But it's the execution is what's the most important. If you don't do anything about these ideas, if you don't take advantage of what these signals mean, well, then you miss it. And that's one of the hardest things I find about trading is actually making the execution on the proper signals. And we can sit here and chart and talk about it all day, but when it comes down to actually pushing that button at the right time or having it set up to do something at the right time, well, it's a little bit of a different story. And that's when you start really seeing more skill come out. But it regained the 9, regained the 21, and so that means it's still good overall. It's only when it loses the 50 that we got to worry about, oh man, this trend's probably over. And you can look at other, and that's where it's just going by the moving averages. We're not even talking about patterns and support, resistance, or anything else that might tell us that this could be a top area. But just looking at these, but when you own a strong trend, you lose a 50, that's usually not the greatest news. Or at least it's not horrible. It doesn't mean we can't recover, because we did, but we went down a lot until we did, right? So you could have, by using those ideas, you can avoid all this mess, which I didn't. Another 15% down. And then you start seeing, oh man, price is going sideways, and now we got the 100 and it's still going out. Oh, we're consolidating. Oh, this is going to suck. We're in a range, and you don't know yet what the range is at the time. Got some other cool tools that you can use, like this little range tool. That's a pretty good little tool. We'll get into that one later. To dice the moving averages. Let me see if we got any more questions over here. Ryan K, what is golden cross, death cross? Does it apply to these MIAs as a real thing? It is a real thing, and that's the golden cross and the death cross is all with the 50, whatever time frame that you're on, is the 50 and the 200. Whenever they cross, whichever way, that's, for me, it's the blue line and the yellow lines. So blue line crosses down, that's technically a death cross is what they call it. And the way I interpret it is like, don't sell now, but maybe the next pump you might want to de-risk. And if it crosses the other way, say if the 50's crossing up over the 200, if we're getting that, that's your golden cross, and that's, I mean, technically that's your buy signal. Death cross is technically your sell signal. The golden cross is, or bullish cross is technically your buy signal, and that's if you had a bot running a moving average strategy, that's what they would do. They would be buying and selling when those cross. Unless you had other parameters like maybe stochastics has got to be a certain level, or RSI is going to be at a certain level to kind of safeguard that trade executing to keep it from happening. That's how I learned about my indicators, was with trading bots. Because I did this totally ass backwards. I learned indicators in a trading bot before I ever learned TA, because I thought it looked like it would be this more easy way to do it. Boy, was I ever wrong. But anyway, in retrospect, that was actually a pretty good education on how to program the bots that I used to use several years ago, like 6 or 8 years ago. Because I didn't learn actually charting and all the patterns and all the Fibonacci's and all that stuff until how long ago? 2020. So yeah, 4 to 5 years ago. But bots will trade those ideas, but they can have parameters that will keep them from just automatically hopping on everything, because when they do that, then your strategy kind of sucks. You gotta have some guardrails in there with the bots to tell them, hey man, make sure this other parameter is met. And those are the concepts that really kind of open my eyes to confluence with the indicators and everything else. So that experience has helped me too. But that's on any time frame. A 50 crossing a 200 is your bear cross, or your death cross, or your golden cross. That's all it means. And it's a traditional buy or sell signal for that particular time frame. It's just that sometimes you'll see that happen, and price might do the opposite for a few minutes before it turns around and goes the right way and respects it. So they can get tricky if you're just you never. You learn this when you trade the bots. You never just go automatically on the signal. You can't just, indicator gave a buy signal, let's buy. And no, you got to have some checks and balances in place, or some other confluence. And that's what I learned from my bot trading there. You can't just go by one little signal. You need multiple signals if you want to have a more successful trade. And that's why you see me combining these things a lot. MG Motorsport says I gotta change my colors and make a list of what each color is because I keep getting myself confused as to what MA is what. Yeah, I found. I mean, I got used to my color scheme, and I think my old mentor had his color scheme. I think we had the same colors on the yellow, the 200, but. Yeah, I find if you get a consistent color scheme, that helps you. I do that with my Fibonacci too. I color code them that way when I come back to my chart. And just take it at a glance. Oh, I know what that level is now. Oh, I know what that target is. It's a fib level. Oh, that one's a measure move because it's colored it's color coded. So those kind of things help too. And your color code doesn't have to be mine, just something that works for you. But that idea, I think, will benefit. Adil says, understood, thank you. Okay, cool. Sometimes I wonder if I can explain myself well. 36-minute time frame, very round. It is, but I don't use it very often. I finally took the 5-minute off. I look at it as a mathematical point, like in terms of hours, minutes, 60s, based on 60. So the 360 minutes, that's what your 4 hour. Watch your mouth suck, road dog. No, it's not. It's not, is it? Oh my gosh, I'm getting so confused. I'm tired. 360. The 36 minute. It was based on the 360 minute, I believe. Right. Because this is getting to some GAN stuff right here. GAN ideas, anyway. So for a circle and a square, the degrees is 360, right? And so the 36 minute time frame is just a division of that, 1/10 of that. It's that kind of concept. That's why I've got it up there. 24 minute because it goes with the 240 minute time frame, which is the 4 hour, right? Say it's true. And so the 36 would be based off the 6 hour, which I took it off of here. I guess I should put you back on there, 6 hour. I forgot. That's why I had you on there, because of the 36 minute. God darn it. So it's more of a mathematical, and I don't really use them all the time. The time frames I use the most, honestly, I use a 6 minute, and I use the 6 minute because of 60. The 60 minute hour. It's 1/10 of that, so I use that instead of the 5 minute. I used to use the 7 minute because it's kind of cool. You know, it's cool in its own right. I just started doing the 6. The biggest thing, you just need, a couple of small time frames, a couple of medium time frames, and a couple of big time frames. And so for my big ass time frames, of course, monthly is on there, but I don't look at it nearly as often as I probably should. Weekly, daily, and then I come down mostly to the 4 hour, 1 hour, whereas my medium time frames. And then from there, I usually use the 6 minute a lot. And sometimes the 1 minute. Sometimes if I'm really trying to get in and nail something, I'll go down to the 1 minute. What I don't do is make my plans on those small ass time frames and try to execute them on it. I'm always trying to zoom out. If I'm day trading, I want to check and see what the daily chart looks like. I want to come down and check and see what the 4 hour, because that's going to be like, if you're day trading in the morning, you probably got a 4 hour window. So you definitely want to check and see if that one looks bullish or bearish. Check your indicators and they look good. Like for instance here, if I were day trading here and we got a green dot on the 4 hour, I'm thinking, well, I could probably have some luck trying to trade the next 4 hours. We might have a go today. We work from that, and then we come down to smaller time frame, like a 1 hour, and start seeing how that's doing. And now if I'm looking at that, it's kind of top heavy, and I'm like, oh, and you might be rolling over here soon. We gotta look. So don't know. Come down to the 15 minute, and then you can see. And of course, my moving averages here, that we just talked about, 800, 36. 666. Well, they're going to give us a little bit of resistance there. And 200, 100 way down here. Yeah, we're at 50's way down here. We're likely to come right back down in these areas. So for some point, is it going to be soon? Is it going to be in the next 4 hours? Maybe. I don't see a good, other than this little breakout that we're late to the game for. There's not really anything going on unless there's a retest. So that would be the idea that I'd be looking for from just what we saw there at the 4 hour. 4 hour looked good. 1 hour didn't. 15 or the other. So we might be coming back for a retest. And if I was looking to try to get into trade, you could take some ideas to shorten it down. I don't think I would do that. I would be looking at trying to buy here or buy here. I'd be looking at trying to get in as she comes down. Always better to wait for confirmation that it bounced, though, rather than just buying blindly. I'm going to throw that in there too. MD Motorcycle says, thanks, Road Dog. Got to go to work. Maze or something I want to learn more about, so I will rewatch over there. Good. And if you got any questions, leave them in the comments for the video, for the actual video, and that way I can find them and address them later on. Kelly L says, I've been learning a lot from these chart school videos. Good, that's what I want to hear. Exactly. Thank you for the feedback. Kelly says, the moving averages are the most confusing so far. Might take some time. Trendline videos was also okay. Well, I mean, you don't have to start out with a 5 moving average strategy. You don't. You can add the moving averages individually. I find it easier to use that 5 MA because, it's just one indicator. And, you can go over here and you can turn them all off. You can just use the certain ones. And what I would recommend, I would recommend, I would use that 9. So I think I would turn on a 9, a 21, and a 200. Maybe if you get comfortable, add the 50 later on. But those two, I think those together would help you out, because if you do that, that would help simplify it until you got used to the process. Let me turn the other stuff off. So let me zoom out and see if we can work out something for this idea. So if you're using that, just these 3 moving averages, you got the 2, the 9 and the 21 will help you cover your short-term price action, what's going on, whether we're bullish or bearish, if we're making progress, if they're crossing bullishly or they're crossing bearishly. You can get used to how that works. And then you got the 200 moving average as kind of the goal as to where price needs to go to. Because remember, it's all about the 200 moving average on every time frame. That's kind of like, that's the zero line, so to speak, that we need to either be up there above it or below it. But we kind of fluctuate. We'll fluctuate on both sides of the 200 moving average. And so it makes a good little target area to shoot for. And I think if you just follow these 3 moving averages for a while and then get used to, you'll get a feel for how it works. And then when you start adding other moving averages in, whether they're the ones I use or ones that you choose for yourself, you'll understand. I think you'll intuitively get a better feel for it. So it may just be all the number of moving averages that might be throwing you off and how they relate. So maybe the 9, 21, and the 200 would be helpful. Because see here in the 1 hour, we see we're up at the 200, and we're either going to get rejected there or not. And now if we're looking at these 9 and 21, we get a bullish cross. So if we get rejected, we're probably going to talk to the 9, and a good chance that we can bounce and then maybe overtake that 200. Do you see how that works? But these crossing bullishly, that's good that they'll stick, and that maybe we can make it above the 200. But getting rejected here means we probably need to come back and talk to one of these 2 guys, so we might be coming back down. Let's see, make sure I turn these back on or I'll forget. Kelly says I gotta rewatch this video too. Well, I mean, if there's anything that's not clear, please do leave comments in the video comment. I set my TradingView to show what each number of my moving averages are on the rise. Yeah, you can do that. All right. I feel like a sponge absorbing all the knowledge. Can't wait for the fibs. The fibs will be coming. We'll have to do fibs in several different sessions though, because it can get down a rabbit hole. But the basic fib stuff is the foundation of it, and I think I can do a better job explaining it now than what I could even a year ago. All right, guys. Well, I think I did what I wanted to do. We covered more than just the 5 moving averages. We got into some trading ideas and setup ideas as we started to get in on how to use like the 9 moving average as like a trigger. And some examples of that, but I think we covered a lot of ground, and I hope I did a decent job explaining the moving averages. Again, if you're watching this later on or anything like that, very open to leaving any comments. I'm more likely to see them than, well, I don't ever see any chat messages after the stream. After the stream, all the chat messages are gone. I have no access to that. So it'd have to be a video comment or something like that. And if you do it over in Telegram, I might remember, but it can get buried, but I'll always see the comments left on the videos. So that's helpful. All right, guys, I'm going to have to go get ready for the nightly stream, the live stream. I'm going to do it 10:30. Got about an hour to get ready for that. So hopefully I'll see you guys there. Okay. See you guys later.
Turkey takes the stage at night, featherless and shining bright.
Kelly says, "Thanks for the tips. I'll try using the 921 I think that will help. I do. You, sir, are finding your groove with the chart school. I'm enjoying and learning more each week. It's like learning a new language first time. I learn to understand, then learn to speak. It does take a little time. It does. It can seem like so much coming at you so fast, but the most important thing is, I mean, actually getting into your own charts and just using this stuff. You get your hands dirty. Kind of like when you first learning how to use the computer. You're like, I don't know, am I going to break it? Oh my God, what happened? Come fix this. Oh, you just press a button. Oh, it didn't kill it. Oh, and you get used to it, and you learn your programs by getting dirty with them, right? And so the more that you get your fingers dirty in here, the more it starts clicking, and it does. The biggest thing is just keep sticking with it. All right, guys, I'll see you in a little bit.